Hi, everyone. Mike Donahue here. Welcome back to the MedTech Jam Session with Chris and Mike D. This is part one of a two-part series where we are going to recap the highlights from this year's 2025 Musculoskeletal New Ventures Conference, hosted by Gary Stevenson and HealthPoint Capital. Of course, I'm here with my partner in crime, Chris Lyons. But we also have Mike Sherman. Both Chris and Mike were the moderators for the two rooms where the entrepreneurs and founders were presenting. So they have some unique insights into what happened. So stay tuned for part one of this episode. You don't want to miss it. But first, a quick word from our sponsor, ConveyMed. If you're a medtech leader, you know how challenging it is when you go to market with a new product. You also know how important it is for your sales teams to be aligned to the purpose and mission of the company, to be connected with each other, and to be equipped with the tools and resources to quickly train on your new technology, but also have efficient and quick access to all the tools that they need to move the sales process as quickly as possible. And that is the platform that we at ConveyMed have created for you. It's called Convey Connect. Built for medtech sales teams, it is a unified mobile platform. It is one app for training, for sales content, includes a private news feed so your sales team can engage with one another, and an AI-powered expert, which can provide intelligent answers to technical and clinical questions. So, for example, if you're a sales rep, you meet with a physician, they ask a question you don't know the answer to, you can query your own AI agent. It will give you the answer, and then we'll give you the resource from which that answer came from. It's giving you immediate credibility as you are going about your sales process. If you are interested in learning more about Convey Connect, go to our website at conveymed.io, where you can book a demo, and we'd be happy to take you through the app. And now, on to the show. All right. Welcome back to the MedTech Jam Session, everybody. I am here with two people who were literally in the room where it happened. So this episode is going to be a recap of the Musculoskeletal New Ventures Conference, hosted by Gary Stevenson, Chris Lyons, and Mike Sherman. I have Chris and Mike. Chris is my usual bandmate, but we have a special guest star in Mike Sherman. Mike, Chris, how you guys doing today?
Good.
Great, man.
Happy to be here.
Yeah, thanks for doing this. So
Yeah.
What a great meeting. First of all, I mean, first one ever sold out. So congratulations to the MNVC team and for running a great meeting. They've been running a great meeting for years. I think people every year look forward to it, and so much so that it sold out. And I think they had to turn a couple people away at the door.
They did. They did.
Yeah. I mean, I've been involved in it for 22 of the 23 years. And there were years where we called up the companies to send people over so that when the keynote speaker came up at the end, we could make the house look full. That was a long time ago.
Yeah.
But no, we've never had a sold out house. And it was kind of, I can't help but wonder, is it part of the COVID bounce back or not? I don't know.
I think it's a coming of age. I think some of that's true. I think that there's a lot of new tech that's being generated and thereby a lot of new interest. I mean, there's never been a negative comment that I've received from somebody that attended relative to, especially in the last few years, relative to the value of the content that was delivered in the time frame it was delivered. That's always been the big deal. And everything, I mean, my phone has still been blowing up. You know, anytime anybody's going to post something on LinkedIn about MNVC, get ready, Mike, because you're going to get it. You've been seeing it, right? Everybody's talking about it.
I mean, people love the conference, right? People love getting together. It's a collegial community. It's a highly sector-focused event, and there's not many of them. You know, maybe there's one other. It's really this sector-focused and focused at, you know, early stage companies.
Yeah.
Canaccord's even broader, but than that. So, you know, people like coming, and, you know, we always wondered, you know, over the years ago, do they still want to come to Memphis? Should we move it out of Memphis? But people like coming, and they like coming back to the FedEx Institute, which is, you know, same place, same drill.
Well, it's a unique venue, both the city and the zone on the campus of the University of Memphis. So yeah, I would, as Gary said on his closing comments, make sure you sign up early next year.
Yeah. That's the truth. There were folks that I know thought they were signed up or that their team had signed them up, and they were hitting me up the day of going, I don't think I'm registered. And I'm like, then you're not.
Yeah. Sorry, bro. Sorry, dude. Yeah. So my only, I guess it's not a criticism. I would love to have seen, and I think there were definitely some strategics in the room. I would like to see maybe more and maybe at a higher level.
Yep.
And the same for investors. You know, it would be good to have some targeted investors in the space. And we'll probably talk about this in a little bit. Given the current state of fundraising for companies at the various stages, it would be interesting to reach out to big angel groups, to large family offices, to come to the meeting, because it is a unique experience, I think, compared to other quote unquote pitch events.
And there were some of those, but the thing is that if you don't know them, you don't know them. There were several. I know that ZB had a BD there. I know that Medacta had BD there. There was a presence of Medtronic. There was a presence of Orthofix with Patrick Fisher being there. You know, but to that point, right, is it the right people in the room, you know, relative to the type of meeting that it is? Totally agree. Totally agree.
And I think if you're an investor or you're strategic, you're completely missing out. Missing out.
Oh, totally.
If nothing else, you're going to feel the energy that new startups, founders, inventors, entrepreneurs bring to a conference like this. So a couple of the highlights, we'll talk a little bit about. First, it's always been a highlight when one of the investment bankers comes and gives us kind of the state of the union, if you will. This year, as it has been the last couple of years, Charles Hamilton from Piper Sandler came and spoke. And I think it was a sobering discussion. There were puts and takes, pluses and minuses. Chris, give us a little recap on Charles's take on the macroeconomy, the current state of valuations, the current state of strategic engagement, et cetera.
Yeah. So in a nutshell, it's funny. I look forward to seeing him twice a year. Typically, once is going to be at the Cabo Spine Summit meeting, because he gives a report out then, and then it's at the MNVC. And the talk track didn't change much since late June at the Cabo meeting, but he's still bullish. He was very bullish of what's coming in 2026, even at Cabo. But you're still seeing, we can see reality, right? We're seeing what's going on around us, and strategics are slow to pull the trigger right now, not to the degree that it's been, but there is some uptake and there's been some good stuff. I think it's still wait and see. At the end of the day, it's like, are we thinking that it's Q1 that we're going to see the board light up? Is it, Q4 next year? What is it? And I don't think anybody's got a really great answer. Mike, what do you think?
Well, first of all, money is still tight for companies. They're having a hard time raising money. I hear it all the time. And when the companies are tight, the strategics can be more strategic, right? They can be a little bit selective about what they want, pay for. They can look for better pricing for what they pay for, and they do. And that just ripples down. But, one thing I heard in my sessions throughout the conference, and it probably supports what Charles was talking about, is all these early stage companies were bragging about their capital efficiency. But the funny thing is, some were proud that they'd done everything, they'd gotten as far as they had on $18 million, and some were proud that they'd done it on 3. And so capital efficiency is in the eyes of the beholder, apparently.
No doubt.
True.
I kind of behold the 3 more, and the 2.5, I think one company was, than the 18, 12 to 18. But look, I mean, this is not new, right? Companies have always looked at uncertain economies as an opportunity to shop for deals. And I don't think any of that's changing now, in the future, or ever. I mean, and when money's tighter, the deals are potentially better. And that's what we're seeing.
Totally.
Yeah, you can argue it's a bit of a buyer's market right now.
It still is. It's been this way. It's been this way since COVID hit.
Yeah, I mean, just going back through his slides, just very briefly, there was the public valuations for medtech today are a little below average, their long-term average, but not much. The last, and there haven't been many medtech IPOs, are trading below the public medtech valuations. So mixed, but not much below.
Right.
M&A deal volume is probably going to be, unless something changes in the next 60 days, at record low this year.
Totally.
Kind of cruising around 40-ish per year. And right now, if we don't get another 10 or 15 before the end of the year, it's going to be the lowest we've had in a few years.
I think a lot of that, Mike, does have to do with who's throwing the fuel on the fire. It does come back to the total ecosystem of LPs putting money into the groups, then then sending the money out to the businesses, and then acquisitions happening and returns on that. It's just broken. It's just broken a little bit right now still. We've been trying to fundraise through Southern Metrics for so many different organizations the last 3 and 4 years. This year, there's a lot more attention being paid than 24, 23, or 22, but they're still slow to move.
Yeah, one question I had for a group that I was sitting at the table with is, I think a lot of these companies potentially, I don't know, I haven't done the analysis, but this is just based on general thought, that a lot of these companies have raised money over the last 4 to 5 years. And then 4 years ago during peak zero interest rate, getting access to money was much easier than it is right now. Is that fair to say?
Yeah.
And so the question then becomes, so we've had a lot of really great companies come to present. What's this going to look like in 3 to 4 years from now, where the companies now really are struggling? Chris, the companies that you're supporting and some of the companies I'm involved with too are really struggling to raise capital. Are we going to have a similar, let's call it cohort of companies come through, or is it going to be a little bit slower because the access to early stage capital is so challenging right now?
What do you think, Mike?
I think it's going to be slower. First of all, I think the companies that are existing and are raising follow-on rounds are going to face down rounds. I think I've seen this a lot. I've seen internally valued rounds, companies, trying to continue to do it internally until they grab an outside investor. And I think there's going to be a lot of disappointed, early stage angels who certain valuation and are finding that it's not always so good to be the earliest or the first, investment. And then I think companies are going to pressure it. If money's tight, valuations will go down. That's
right.
And companies are fine with that. The strategic companies are fine with it. Early stage companies obviously aren't. But I think maybe the market already senses it, because I've never heard them brag about capital efficiency as much as I did this year. That stood out as a repeating theme.
Totally.
And I guess it's finally trickling into the early stage, CEO realizing that it's appropriate.
Mike, that's not a bad thing. I think it creates discipline in a company to be capital efficient in the early stage. And then as you go commercial, you are focused on a balance of growth and profitability. And speaking of which, one of the last slides, he showed that revenue growth and profitability remain the top drivers of premium valuations in medtech. Those companies that are 10+% growth, 10+% EBITDA are in that top right. There's not many of them. Their valuations are almost 7x their 2025 revenue. Whereas if you're below that, if you're on the other side of that 4 square box, you're trading at 1 to 1.5. That's a huge difference. And so somewhat instructional for companies that are going commercial to balance growth and profitability in a world where capital is constrained.
Yeah.
It's hard because, you need dollars to drive growth often. How do you do it? You do it with bigger sales organization or more. That's typically feed that beast as you just start scaling it. But growth is hard. It's a tough one. It's sort of the wide and narrow or narrow and deep discussion,
Right.
And I've always narrow and deep, prove the model, and then go drive it with capital later. But I don't know.
Even narrow and deep is tough, because you think about where we're at. It's almost like a perfect storm. Reimbursement for the docs is going down pretty much year over year in some form or fashion. VAC committees are more aggressive than they've ever been. Money's tight to come into these companies at the same time. So it really does take strategy and very well planned effort of how you're going to do what you're going to do to build this business these days.
Yeah.
Before now, you might have one of those 3 things that was out of whack, but when you have all 3 that are working against you in a way, right? Surgeons are going, well, wait a second, I get reimbursed better for this and that and whatever, but they're not happy. They're not happy. It's very clear. And you look at the VAC committees and they've got more power than ever. And then you look at the investor side of things and it's like, we have to fuel innovation. We have to. I mean, it's just a given.
That's a very well said, Chris. Thank you. So let's pivot. The next lead in would be, we had another highlight of the meeting is the investor roundtable that Gary was in, led, of course, with Michael Collins from Core Medical, Chance Leonard from Genesis Innovation Group, Nick Pachuta from Neovate Capital, and Jeffrey O'Donnell from Runway Healthcare. Each of those have slightly different thesis. A couple of those are more venture studios. The other one is more of a traditional VC. And so what were your takeaways from the investor roundtable? I thought that session could have gone on for a little while longer.
Oh, it could have. What do you think, Mike?
Yeah. Well, I mean, I do think and I've been thinking about it. The contrast between a pure investor and a venture studio investor is kind of profound, right? So the venture studio has a bit of a motivation that's different from the pure investor. The pure investor is purely financial.
Yeah.
The investor studio has a bit of a component where they have a team of development people they have to feed, right? I mean, their models may be a little different. I'm not as familiar with Genesis, but Core has a staff. And so that staff needs fuel. And so it definitely impacts, and to be fair, I compete with Core. I mean, that's, at MBI, we compete with Core. We're developing products for other people. So I'm going to take my comments with a grain of salt. But it's a tough comparison between the two because the motivations,
I agree. I think, Jeff definitely had a lot to say, as well as Nick did, relative to the direction of things. And, and to your point, there's puts and takes in each model. You know what I mean? I don't think any of them have cornered the market relative to a successful game plan, just because each one of them's different. But, when you look at what Nick's doing, he was very bullish about the way things need to be heading into the future. And the differentiation that needs to come alongside of that. And I think it was Nick that was focusing on the whole FDA side of things relative to, putting up bigger barriers by not just being another 510K. And I was thinking about you, Mike, in that regard, because it's like you deal with a lot of technology that you see come through your channel alone, and I know that there's a ton that's just 510K.
Well,
I don't know many companies. Yeah, I don't know many companies that are PMA or IDE based.
It's hard on skinny capital. It's hard, right? You talk about capital. It's really hard it takes millions and millions of dollars to run the studies. Now, the idea of using regulatory as a strategic barrier to keep people away, or competitive barrier, is something that the Viscogliosi brothers, and Mark in particular, have talked about for decades, really. Now, I will say the venture studio component of it does help you drive efficiency because you can really leverage shared resources in that model. And I think that's the real benefit of the studio model. And it's worked before there was the buzzword venture studio. I mean, there were people doing this a long time ago and successfully. So, but capital efficiency does drive a lot of decision making, I think.
Totally.
I think, I thought Nick Pachuta's commentary on, we need to be thinking about more transformational innovation and less about, incremental innovation. And we haven't seen a lot of that in musculoskeletal for a while. So, I mean, it sort of puts the industry on alert.
I can think of one right off the bat. I mean, they all swim in the same bucket. You had some of them presenting at this meeting, but, just like with Cytex Ortho, who Brad Estes, he's been a presenter before at this and so forth. And I'm sure he'll be back again, but it's, he's one of those that's trying to break the mold. And there were others that were even present here that are on that same plan towards execution at this meeting, which was good to see, but it's few and far between. If Mike, when we think back to our BD days, it was always like, at Medtronic especially, it was always like, what's your plan, relative to that? And at that time, it was not seen so much as a negative to have to do an IDE PMA, but it was definitely seen as a differentiator.
From my side, it was a negative. You were after me, but when I was doing it, we didn't want to buy PMA.
I know. But that was about the only ones that had the opportunity in musculoskeletal to possibly exit before commercialization back in the day.
But the difference is when you're Medtronic, your strategic, defense against your competition is your sales organization. You don't need clinical studies to keep the competition at bay.
That's true.
That'll help, but you got, top quality, huge sales organization, driving things, and that's hard to compete with. I mean, that was their advantage, and it probably still remains so.
Yeah, for sure. Thanks for listening to this episode of the MedTech Jam Session, where we covered part 1 of our recap of the 2025 Musculoskeletal New Ventures Conference. Thanks to Chris Lyons and to Mike Sherman for jamming with us. Please subscribe wherever you get your podcasts. If you get a chance to leave us a review on Apple Podcasts or Spotify, that would be awesome too. Forward the link to all your friends. We're here to help prop up and continue to build out the MedTech ecosystem, and we're having a blast doing it. So thanks again for listening, and we'll see you in part 2.